Hi, I'm Peter Smith from South Bend, Indiana, and my journey is much different than Claire's. Uh, I served 4 years in the Navy in the early '60s before the Vietnam War and after the Korean War, so we just sailed around but didn't do any damage. Um, but then I went to the University of Wisconsin to get a PhD in mathematics, and the Vietnam War happened, and it was a very radical place in, at the University of Wisconsin. I'm also a Catholic, still a Catholic actually, and we joined a group in Catholic Center and did a lot of uh, radical things, uh, and culminated in a trip to Montgomery, Alabama, when they marched, Martin Luther King marched in there, and to sit to see him and listen to all the speeches and so on, and it was very good. Um, but I was a draft counselor as well, because a lot of the young men at the university were wanting to refuse the draft, and some of them went to Canada, others just refused to go to the enlistment or the place where you signed up. And I said, well, I mean, I need to do something. And so I decided that my money was supporting this war. And so I decided that I would become a war tax resistor. And first I did the uh, telephone tax, and then soon after that resisted the military portion of the tax that the uh, War, War Resistors League puts out a pie chart every year, and I use that to decide how much a tax dollar goes to the military and past wars and so on. Um, I've continued that pretty much now. I'm 85 at this point, and so I've had a long uh, journey. Um, I My partner Ellen is also a war tax resistor, and after we were married in '81, we filed jointly. So I've always filed my tax return. So I've not tried to live below the taxable income. Both Ellen, who is a medical doctor, and myself, a college teacher, uh, we had we had went through a lot of training and schooling and so on, and we didn't want to live below the taxable income, and then because we really loved the things that we were doing. So as a result, we just refused to pay the money that beyond the we paid the non-military portion, but not the military portion of the taxes. Um, and um, so as a result, our tax debt gradually increased. First, and we haven't been successful in keeping our money from the IRS. They first garnished my wages at the college that I was teaching at. And in fact, that was the first time that had ever happened to the people at the college. It was a small Catholic college for women. And the business managers wanted to fire me right on the spot. But fortunately, my department chair said, no, we need him to teach. So soon after I got tenure there. But 20 years later, when the business manager retired, he wrote me a letter and said, I really admire your stand. So it kind of shows what nonviolence can do to try to turn people around. Um, uh, in another cases, the IRS has seized our bank accounts, our retirement funds. Um, I was a little surprised that when I got the uh, tax bill for the next year, because retirement funds are pre-tax dollars. So I was supposed to pay taxes on the retirement funds that they had seized from me. I didn't pay it, but that was what I was supposed to do. Um, my wife got Medicare and Medicaid dollars for her patients, and they took that. Uh, we Social Security, when we started getting Social Security, they took 15% of Social Security. That stopped when COVID came along, and it hasn't started again. I just checked last month, and Social Security still is not. They still haven't re-upped the review the 15% tax on it. Um, I when they tried to garnish my wages, well, first of all, how I succeeded in not having the money taken out of my pay for while I was working is I inflated the number of allowances on my W-4 uh, so that they wouldn't take out uh, enough, so that they would have left um, in my income the military portion of the taxes. Uh, and but late, just towards the end, just as I was ready to retire, the IRS came and said, no, you got to claim zero allowances. So it was a kind of a lock-in letter, which I don't know that they're doing much anymore, but that happened to me. Um, a little bit like Daniel, I reduced my teaching loads, so I went down to 2/3 time teaching, so I wouldn't be earning as much as, and so I wouldn't have that much of the taxes that I would have to refuse. Um, well, that's pretty much my story. The But I wanted to say some things about how one might save for retirement, and in so doing, if the person is going to be working, uh, um, and in so doing, reduce the amount of tax that you're liable for. So that's one of the kind of the a good thing to say. Both you have some money for retirement, and also you will have reduced your taxes along the way. Um, of course, you can always put your money under the mattress, but that's not going to be terribly effective, at least as far as reducing your tax liability. Um, it's fairly easy to do, and if you're interested in reducing the income tax you're required to pay to zero, you might look at Daniel Gross picket line. You just Google picket line and then put Daniel Gross name in it, and it'll come up under Google. Uh, he has what we call the don't owe nothing method, DON he calls it. And this past year, every year he puts out his tax information, his tax return, and how he has successfully not had any tax liability. He was able to make $45,000 in 2023 without having any tax liability. And the way he does it essentially, I'll explain it a little bit. So the first thing we want to do is open an IRA, or individual retirement account. It can be done through your employer, or it can be done through a financial institution. And you want to put as much as you can into that IRA. I think there's a limit of 7,000 for a single person, uh, and 8,000 if you're over 55. But that's quite a bit of money that you can put away, and it's subtracted from your taxable income. So it's pre-tax dollars that you put in that IRA. Um, the the other thing is, through an employer, you might be able to put money into a 401k or a 403b or a 457b, something of that nature. And that's in addition to the IRA money that you can put on. So you can keep that's all subtracted from your income before you have to pay your taxes. So those are some ways of building up your retirement money, and at the same time reducing your income that's subject to taxation. Um, you can also contribute to a Roth IRA, which is where you put the money in, but it's money that's after tax. You don't benefit tax-wise from a Roth until you take the money out, and then it's tax-free when you take it out. Um, um, okay, after you turn 59 and a half, you can withdraw money from the various retirement instruments that you set up. Uh, and But the money then is taxable. The ones that you put in before tax is taxable. Uh, and then when you get older, at this point, it's when you turn 73, you have to have money taken out called a required minimum distribution. Most of you are not looking forward to 73, but I am. I have to, and that's another way. Once we retired, we had a little stretch where we didn't owe anything because we didn't have any much income coming in. But once the required minimum distribution kicked in, then we had to start taking money out of these retirement funds, and so then again we had money to we had to refuse to pay various the money that we got from that. However, once you turn 70 and a half, you can take out money from your retirement funds and give it directly to charity. So that's another kind of a way to do redirection. And then when that's called a qualified charitable distribution, QCD, and you don't have to pay any taxes on the money that you take out and you send directly to charity. So again, it's a kind of an old person's process, but it is a way to reduce the amount that you would be subject to tax. The final win-win tax strategy is healthcare insurance. That's one of the big things that retired people have to worry about is whether or not they're going to be able to survive a health emergency. So there are two ways of doing that. One of the ways is which David Gross does is purchase a high deductible insurance plan, health insurance plan. That means that you have to be at least $16,000 of your own pay before you get any help from the insurance company. So it's really a catastrophic type insurance plan, which is fairly cheap. And at the same time, put money into a health savings account. And that can either be through your employer or you can set up your own health savings account and put money into it. You can put up to $44,000 or $5,000 if you're over 55. If for a single plan or for the family plan, you can put over 8,000 into a health savings account per year. And if you don't need the money, then it just carries over year to year. So if you've done that during your life as an employee or working, then you have a lot of money ready to pay for health insurance when you're older, after you retire. You can use the money for the HSA to pay for the health insurance as well. So you don't have to pay anything for your high deductible health insurance because the HSA money will pay for that. And that HSA money is deductible from your taxable income. So you're saving for retirement and you're also reducing your taxable income. You can also pay for medical, doctor's bills and dentist and any kind of medical bills with that money. And you can even get over-the-counter medicine like pain medicine and that kind of thing from an HSA. So the other health insurance strategy, which is in the number 7, the practical number 7 in Newtrick. You can just go to Newtrick and you can find that practical number 7, and that's using the Affordable Care Act, Obamacare, to get your health insurance. That doesn't directly reduce your taxable income, but it does give you the opportunity to get a reduction in your taxes. And Robert Randall he passed away last year, but he was delighted to be able to take advantage of that ability, so he didn't have to have any tax. He had taxable income, but he was able to reduce his tax using that method. And so the way you do that is you can't be eligible for any other kind of health insurance. So you have to be make more than you would need for Medicaid, and you have to make not have employer insurance. So, but it's healthcare.gov. You call them up and you ask to have a insurance plan, and they ask you for how much you would expect to make in the year, and that determines how much subsidy that the government will give you. And then they'll say, well, this is what you have to pay for your insurance. And then you say, well, what would I have to pay if you didn't give me the subsidy? And then you want to pay as much of that premium as you can, because when tax time comes around, then they're going to give you the rest of the subsidy as a subtraction from your tax, and you may even get a refund because it's a refundable credit. So anyway, that's the other method of what I'm talking about.